Hi, everybody. This is Hyperwave. We have Tone streaming from the car, looking alpha as usual. Tyler and I are back on. I have missed streaming with you, Ty, partner. How's it going?
It's going terrific. The markets are not going terrific, as everybody knows. So we want to take a deep dive into traditional markets mainly. I'm still pretty uninterested in Bitcoin and crypto. It's caught in between this 3,200 on the bottom, 4,200 on the top. Tone has been saying he thinks it can take out 42 and go to 5,000. I don't disagree with that. I just think there's a lot of resistance at that 4,000 to 4,200 level. It keeps struggling. I don't think it needs to drop too much further from here, and it's going to fall into trouble again, but we'll take a look at some charts of that. But the big news is traditional markets. Yesterday was the largest point gain in U.S. history, not near the largest percentage gain, but the fact that we saw small cap up 6% yesterday, the other indexes up 5% yesterday, just shows how oversold it was. And we'll pull up some charts to take a look at that. So this will be, I think, a very important an important look at things. I also wanted to mention, be sure to check out Unconfiscatable. It's filling up fast. It's going to be absolutely the place to be worldwide because of the fact it's a Bitcoin conference. And the speakers are Bitcoin speakers. Some are maximalists, some are developers. You've got the cream of the crop there. We've got the poker tournament that Tone has set up that's going to be unbelievably fun. Just talking with everybody around the tables. A lot of very, very interesting people. A lot of very interesting clients who are all brilliant in their own right. And you'll have hours and hours and hours to be able to talk to everybody. So just one last plug. We still have about 10 seats open for the Hyperwave workshop. We've got 40 already filled, and they will fill up very quickly here. And shout out to Tone for making it available for us to be able to increase the size of that. So that's the big thing on the calendar for the year coming up. And I know it's going to be successful so that every year after this, it's just going to get bigger and bigger. So that's big time stuff. And back to you, Leah.
Thanks, Ty and Tone on the move. Thanks for joining. How it goes?
Welcome.
Awesome. All right. Well, that's what we get from Tone. Please don't look at our charts, Tone. We will have you wing it because we do not want a car crash on our hands here. So let's actually go straight to charts. But yeah, Tone, thanks so much for joining us today. All right, Ty, let's see the markets.
Okay, what we will do is we're going to take a look first at Bitcoin. Tone doesn't need to look at a chart. He's got it memorized right down to all time sequences from the minute chart all the way out to the monthly chart. So he'll know exactly what we're talking about. So I am going to pull this guy up and we'll take a quick look and see if there's anything going on. There wasn't the last I looked. So let's see here. I'll go there and then I'll go here. And what you're looking at, I'll pull up the weekly. We're going to look at the weekly chart of Bitcoin. For the last 6 weeks, we've been stuck at the 4,000 level, 4,000 to 4,200 on the top, 3,122 on the bottom, which was 2 weeks ago. Had a big up candle that looked like it was going to go somewhere. We've only got a couple more days, 3 days basically in the week, and we're sitting at 37.48 right now. and we do have a number of price flips, and we've got some nines coming up that Tone can talk about. I see this weekly chart and just basically say nothing has changed. We're still in the downtrend from 19,666. We've broken major support at 6,000. We've broken the phase 2 trend line of the hyperwave, which calls for a drop down to 1,000. I have not changed any of my thoughts on that. It's just how long is it going to take and where is it going to finally bottom out? And I'm going to just turn it over to Tone. He's going to have to jump off in just a second, then he's going to jump back on when he gets to his apartment. But Tone, what are your current thoughts on the length of time of this bear market and the potential lows?
What's the current price right now on Bitstamp?
37.42.
Yeah, I don't like it in this area, and it's now been in this area for over a day, like probably close to 2 days. And that's starting to make me a little bit nervous. My line in the sand is approximately 3,600. If we start dropping below 3,600, then the $3,000 number is in jeopardy, like very early next year. I mean, it's weird how closely Bitcoin is resembling the 2014 and 15 bear market. And the last thing I would expect is a crash in Bitcoin down to the 1,500 area the first week of January, because that's exactly what happened in the last bear market. But all signs point to that now.
Now, talk a bit about if and when we drop below 3,000. Do you see any support below the, let's call it 2850 level?
I don't. I don't see any support in the 2850 area because it's too close to 3,200.
Yeah.
This was the same problem that I had. This was one of my problems with the $5,000 area being support, in that I was always calling for a drop to 5,000 if it would have happened like in the summertime. But when we got stuck at 6,000 for another 4 to 5 months, the only thing that like the 5,000 just became another round number, and it was now way too close to 6,000 because 6,000 has become so critical after being stuck there. So my view is, if we fall back below 3,200, we are falling below 3,200 way too close in time to when the last time we were there. And 2,800 is so close to 3,200, there's no reason for 3,200 to hold up the 2,800, sorry, to hold up the price the way 5,000 couldn't do it because it was too close to 6. So you need that perfect time span. You can't fall too close in time and you can't fall too far away in time. So to me, that $2,800 area, in order to act as support, we would need to fall to that area sometime in February, maybe early March. If it's later than that, we're going way lower. If it's earlier than that, we're going way lower. It's always about price and time. It's about how many people start believing that the bottom is in and they end up on a bad side of the trade, and that means more people need to exit. That's if it takes too much time. And if it takes too little time, then there's no one yet ready to buy at 2,800. So you need that perfect time period where it's not too long and not too short, and then 2,750, 2,800 could become support. But right now, it's not looking like it. Now, way too many people are now expecting approximately 1,000 to 1,300. And because of that, I have a feeling we may bottom out higher than that. But we will see how that progresses. I don't see the end of this bear market until late summer, maybe early fall, maybe even late fall.
Wow. Yeah, I can't disagree with any of that, except I keep going back to Hyperwave. I think if it's going to get down below that 1500 level, we got a very strong possibility that even 1,000 is not going to be a terminal point, that we might see 800 or 750, at least on a spike. And if so, that should be enough to clean out a lot of these alts and a lot of the ICOs, and then maybe we are in a position to take a run. It depends on a lot of other stuff, including, I think, a lot of these bigger questions about U.S. stock market and the gold price, which continues. The gold price continues to show remarkable resilience, a lot higher than I thought it was going to get. It got up to 1280-ish today, and I have been a believer that it would struggle down at the 1220 to 1230 level. We'll take a look at that. What we're looking at now is the stop and reverse points on a weekly basis, and we are now below 6,000, which is very important, because now that the stop and reverses are accelerating to the downside, every week that goes by is going to put tremendous pressure on price action being able to go back up. In another couple of weeks, we'll be down at the 5,700 level, which would be lower than the low range between 5,785 and 6,200. And I think that will put a bullet in the head of any possibility of getting back above 6,000 on a bounce. We'll take a quick look at my moving averages, the Consensio. I'll take the price off here just to indicate how bad the situation is. We do have the short term bouncing back up just below 4,000. It has not yet crossed above the intermediate term. And if price turns down from here below 3,750 and the 3,600 that Tone thinks could be a drop deadline, we will be once again in a full bearish posture in terms of Consensio. Right now, it is not even considering a short-term bounce from here. And with that, I will put the price back on and take a quick look at the RSIs. The longer we don't drop down, the stronger the RSIs get. And the stronger the RSI gets, the worse it is, in my opinion. We've actually turned down now slightly from the high of 38 after breaking 30 just literally in about a 24-hour period before this recent bounce. And we're now back down to 36 from 38. So that gives us 8 full points to drop just to get back down to the 30. And I still believe we're going to see 25 and maybe as low as 20 before capitulation, wherever that's going to occur. Any comments on the RSI, Tone?
Tone, you're muted.
There we go. Trying to unmute. No, not really. Everything is fine. I don't know how much longer you want to talk about Bitcoin. I was going to answer this question on my YouTube channel. I'll try to answer it real quick. Let's just stick to the high level Bitcoin. Someone in my chat group asked me about Martin Armstrong's thoughts on Bitcoin. So Martin Armstrong said if Bitcoin closes below like 4150 or 4130, I forgot what his number was. He said if it closed below that number, then it's going down to like the $700-800 range. And while it's possible for Bitcoin to go to the $700 to $800 range, what I will say is, I mean, I was a big follower of Martin Armstrong for a long time. And my problem with his method is that when he says if Bitcoin closes below 4140 or 41, let's say 4130 is his number, right? Then it's going to like 700 or 800. He literally means 4130. That means if it closes at $41.29, it is 11 cents below 30, and therefore he will now have a target of $800. And that's the part that bothers me to no end, because things are a little more subjective and he treats them to the penny. So that was a question in my chat group. So hopefully you guys are watching. In general, it's reasonable. Like if we, based on his theory, if we close like below 4,000, yeah, I can buy that. But it bothers me that if we close 15 cents lower, he doesn't adjust it. Like it's all the same to him. It's like a computer. And I don't like those methods.
Tyler?
Yeah, I agree completely with that. I have never found technical analysis to be that precise unless you're breaking a significant trend line on a weekly basis. Other than that, the precision of individual numbers, maybe on Fibonacci, but even on Fibonacci, I'm not a big adherent to that. Okay, let me.
Right, and even if we ignore the fact that the price of Bitcoin is subjective because we don't have a single price of Bitcoin. So let's assume we had a single price of Bitcoin like we have for the S&P 500. I still don't like that method.
Yeah, I would agree with that. A very smart guy, but I do disagree with some of the things that he used as his tools. None of us are perfect. We all make mistakes, but that's not one I can go along with. Okay, so what is the problem here? I'm trying to pull up.
You're on silver right now.
I know. I'm trying to pull up the indexes. Here's the Dow, but it's not coming up. Why isn't it coming up? Let me just get out of this for a second.
Yeah, absolutely crazy right now. I hope that everybody's following traditional markets. Tone, cool shirt.
Thank you. I want to go grab an actual shirt before I switch to a real computer.
So
apartment now, it's like, yes, it's more.
So I guess I'll just throw some update people while you're getting that up, Ty. I can see your screen. Yeah, so the Dow lost more than 500 points at one point, after its first $1,000, 1,000 point gain. Nasdaq slipped 100. Nasdaq 100 slid more than 2%, I should say. Eroded some of 6%. Surge. It's just going pretty nuts. Biggest point gain, as Tyler said, in U.S. history, not by percentage, but by point gain. Now they're faltering again. My favorite, WTI, is also down. Lots of craziness. Ty, looks like you're okay. Still kind of.
I'm gonna have to bring this back up. So if you can just talk for a little bit.
I'll just ramble, I guess. But yeah. All right, Tone, you can jump in anytime. But yeah, it's if S&P 500, we're looking like we're smart.
I can answer another question that was asked yesterday on our show as a tipped question, and I totally forgot to answer
Your Satoshi question?
What's up?
Your Satoshi question, naturally?
Yeah, the Satoshi question, right? So I don't know if the person is watching, but the question was, if Satoshi holds 1 million coins, which I doubt, I think it's closer to 500,000, but let's assume that Satoshi holds 1 million coins. The question was, does that bother me? And the answer is no, it doesn't bother me. The reason why it doesn't bother me is because Bitcoin is proof of work and not proof of stake. If Bitcoin was proof of stake, I would not hold a single Bitcoin because then it would bother me. Because then he would have the ability to create more Bitcoin by having the most amount of Bitcoin. Again, people that have the most amount of money without the ability to print more money and without the ability to use the government to make themselves more money do not bother me. This is what capitalism is supposed to be all about. So no, I am very happy that Satoshi is holding his 1 million Bitcoin. I'm even happier he never spent it. And if Satoshi is a single person who is still alive, both of those probabilities are on the low side, that it's just one person and that he's still alive. And if he really wanted to do something with those Bitcoin in order to create more confidence in the Bitcoin market and not less, he would make an announcement and create a smart contract with, like, I don't know, lock time verify or something, and put those 1 million Bitcoin on the back end of mining. After mining is giving you less than a 1 Bitcoin reward per block, he can always redistribute those Bitcoins randomly across the ecosystem if he doesn't need the money. That might be the best thing for him to do to give even more confidence to the Bitcoin world.
That was a good answer.
Yeah,
yes, Tyler, I see yours is up. And just because people have been asking, yeah, yield slipped, gold climbing with yen. And just as a note for people who don't follow it, my background, yeah, Asian equities. A lot of people, and Tyler, you can talk about this in another show, I guess, put their money into yen as a safe harbor sometimes during volatility. So that is always kind of a fun one to follow. Ty, I see your turn.
Yeah, just a general comment. I think all the normal correlations are breaking down very quickly between the dollar and gold, the dollar and many other currencies. Various currencies are acting very strangely. What we've got up now is the S&P 500, which is really what we wanted to talk about today. I think everybody knows that this is going back to the end of 2017, the big run up through the third week in January, where we went to all new time highs. And then we had the first break in the S&P in January and February, late January, February, down to 2585 approximately. We then ran back up as high as 2,800, all the way back down to 2,580 again. Then we had a long period of time starting in April where we went to all new time highs in September. Remember, it was September just 4 months ago that we were at all new highs in all the major indexes until we dropped down back to the 2,600 level, triple bottomed, and could not hold. So what we're really talking about today, now you've got this visual, is we're talking about this latest move, which on a weekly basis, this is a daily chart, which means that in 1, 2, 3, 4, 5, 6, 7 days, we dropped from the lows of 2640 all the way down to the lows of 2 days ago at 2351. We then had this explosive move up of 1,085 points. And so far today, we are struggling, and we are currently down 13 points, which is only 0.5%. My feeling is that this is a significant reversal from a very oversold position where the RSI and many of the momentum indicators had reached the lowest levels they had in many, many years. And on that basis, I thought it was time to step aside of inverse funds. We'll take a look at some inverse funds in just a minute, just to see how far this bounce goes. My thinking is it's going to be able to get all the way back up to the 2620 area, these bottoms going all the way back into October, and probably not higher than that. Somewhere in that range, depending on how long it takes to get there, I would reestablish my inverse positions. As I'm sitting right now for my discretionary clients, we are 50% long and we are 50% in cash. And the reason I've still got those longs on is because of this bounce. As of yesterday morning, I was at 0 in terms of neutrality in the market because I had 50% in inverse positions and 50% long, which means if the market went down 10%, I would go down 0. And if it goes up 10%, I would go up 0. In other words, I was totally protecting the client's assets by becoming neutral, by taking profits on my inverse funds. That's one way that all of you can use inverse funds instead of having to get completely in or completely out, having to do with Consensio. Now, where we sit today is I am trying to determine, and I'll let Consensio tell me, if I'm going to use some of that cash on the long side. And right now, Consensio is not signaling that in any way, or I'm going to start putting inverse funds back on and get back into a neutral at some point higher than this, let my longs run until the market runs out of gas. Tone, what are your thoughts in terms of what you've seen on the traditional markets over the last couple of weeks?
Let me do my own screen share real quick.
Great.
So I really like the fact that we have a perfected 9. I was worried that this would not be a perfected 9 on the daily chart. But because the S&P 500 made a slightly lower low yesterday, and we were able to get a perfected 9 today. Now, the markets yesterday were like just a crazy up day. I'm not surprised we have a little bit of a pullback here. So, like, we have to go down a lot more for me to get nervous. I like the bounce. Is this bounce sustainable to?
You just cut out, Tone.
Lost you for a second, Tone. When we can hear you again, I'll let you know. Tyler, you want to pick up until we can hear him again?
Yeah, if you take a look at those moving averages, this is what's important to me, that these are different than my Consensio, but this is on a daily basis. Notice that even with that big bounce, it's not enough to even turn the short term or slow it down. So that's why I say in this 2600 area, if we continue up, we're going to start running into a lot of resistance. Tony, you back there?
We got him back.
Yeah, I don't know what happened there.
Okay.
My connection went out. But I'm not sure how far you guys got with me.
No, we heard you talking about the 9, and you were starting to explain it.
Right. So it would have been great if yesterday's candle was taking place today and not yesterday. But it is a reversal, and there's so much headroom before we hit any kind of resistance. You have the 20 period moving average, you have the setup trend resistance, you have the 50 period moving average. I mean, I'm bullish until the price comes back down and gives me a new closing low.
Yeah, I think that's exactly right. And your lines are coming in right around that 2600 area that I was talking about. And that's still a nice move up from here. We could be running another 200 S&P points to the upside, and that's why I think anybody that is playing the inverse is on the wrong side of this move right now. I have no idea how long it can go. What would you think if we start moving up here and get a green above a green? Do you think it's only 1 to 4?
Not much, because I'm still looking at the 1 to 4 candle correction, and the 1 to 4 candle correction of a 9 is very general, right? Like there's no specific rules on this. Sometimes the 1 to 4 is just a general 1 to 4 candle correction. Did that correction to the upside start yesterday morning, or is it going to start tomorrow? Like, I have no idea, right? You don't really know until after the fact. So I always wait approximately 4 candles in the vicinity of a 9 before I reevaluate where are we going next. Now, if we start to go lower, if we start approaching new yearly lows, next week, then I'm gonna say, hey, the correction was 1 day, that the greatest day, in S&P history by absolute terms, right? So, so I have no idea. So right now, I'm bullish until the market tells me otherwise, because the 1 to 4 candle correction is telling me to be bullish.
Yeah, exactly. Let's do this. I am going to pull up other indexes just to, I'm sure everyone knows this, but make sure. Let's take a look at the Nasdaq. Exact same thing. Let's roll it back. This is the going all the way back to 2016. And we yesterday got as low as we had been back in 2017, and have taken out the lows from February and April of this year. We need to get back above those on this bounce for it to be able to continue up. But that is a very worrisome chart. We are still, I am trying to draw a conclusion if this was phase 4 of a hyperwave or simply a phase 3. And what we do at this point, if this is a 5, we should have a significant move up in a 6, and then a very long and very dangerous move into a 7, with the only possibility of holding being a funky hyperwave holding the 3. And I have not drawn a conclusion on that at this point. It's just too early. Taking a look at the Dow Industrials, the exact same formation, which would imply a bounce back up to 24,000, maybe as high as 25,000 or even 26,000, which is why I do not think that inverse funds or shorting or puts are the right place to be with the way these markets are looking right now. I want to take a look at mid cap and small cap and some of the internationals. Let's take a look at, let me pull up, wow, why can't that come up here? I'm not sure. Let me pull this guy up. Let me do that. There's something wrong with my trading view. So,
all right, what question you guys have? What Tyler's working on it?
yeah.
Yes, buybacks are crazy right now. It's my understanding near record like share buybacks, which is crazy during the bleeding in the market. Definitely, I think at one point we should talk about it. And we got Tone back. Tone, Tyler's working on Trading View. You want to hit a question?
Sure, go for it. I mean, I heard everything you guys said. I was up in the kitchen.
What are you eating?
Can of sardines. I don't have time for food anymore. This is what happens, right? Like, I was at the gym all morning, and I'm home doing this podcast. We may do my podcast. Then I got to do the law show that I still have to prep for. Like, when the hell do you eat? Because for me to eat, I have to, like, cook, you know, because I'm home.
Oh, my
God. What's the
God.
question?
That's what you're at. I think Postmates is like the New York thing. Tyler, let us know. Otherwise, Tone, you ready for some questions? Or
Yeah, let's do it.
I'll ask you some hard questions myself, which is always my favorite. Okay, well, a lot of these are for Trading View. Let's see. Well, I'll hit you with buybacks. We can have a little fun. One person asked, do you think that buybacks was one of the reasons for the jump in stocks yesterday?
No.
Tyler, do you want to answer, or are you focused right now?
No, buybacks had nothing to do with it. Buybacks have been going on all year long. It was purely technical, way overbought, and every overbought market corrects in the opposite direction. It's just a matter of when it occurs. You can come up with 6 reasons where everything aligned in terms of the Chinese actually looking like they're going to try to get together and do something. Trump stopped beating up on the Fed. Trump said that he's got a lot of confidence in Mnuchin, and all of that relieved pressure. And when you're deeply oversold, that's all it takes. And then what you get is a short squeeze. And that's exactly what happened yesterday.
Well, and tell me what you guys think about this. But in my opinion, I mean, I think that you could also see buybacks as a real defensive measure. And so not everybody should actually just look at them as a positive. And yes, of course, like, well, their main purpose is to provide, you know, raise in gains, and yes, that it can provide a pump, but at the same time, it's also because investors are typically a little upset, and it's just one way to get it back. But also, if they want to shake up management, if they're worried about what's going on and want to therefore buy up the float and therefore have a little bit more control, it can happen a lot of the times right before a recession, but also when they're just worried about what's going on with the markets and with their own products. Well, not just products, sorry, companies. I mean, when you buy, let's say Apple, you're not buying the iPhone, you're buying the company, right? So, yeah, worries. Tone, am I out of here?
No, you're fine. I mean, I'm like the only person that don't care about, I don't care who's buying the stock. Again, I'm anti KYC AML. I don't care who's buying the stock. I don't care if it's the company, right? You're running your company has extra money. It's none of anybody's business how you're spending that money. If you have no research and development to spend it on, if you don't want to raise people's salaries because they don't deserve it, and you want to buy your stock back, buy your stock back. It doesn't matter.
Yeah, absolutely. I mean, actually, yeah, you guys know I love the fundamentals, but if you guys want to think about it this way, it means they have a whole lot of liquidity potentially. People should look into current ratios, to be very honest. So yes, you technical analysts who price in all the news, but yeah, I mean, it's an interesting situation that they would actually have so much cash. You're right that means they're not putting.
When you start telling a company what to do with their money, you might as well be back in communist Russia or China.
Yeah. I mean, actually, it's kind of interesting that it maybe ties into the Bitmain story yesterday, where the IP is. Go for it.
Look, I haven't read Zero Hedge in 4 years. I'm happy as as I've ever been as an analyst and a trader. And I bet you all this shit is coming from like Zero Hedge.
Tyler, we got you back up.
Yeah, I switched over to stock charts. Something's messed up with my trading view, but here is the Dow. And what I wanted to show is the MACDs on the Dow Jones Industrial Average plus the RSIs. Now, I've been saying on Bitcoin, where you get this kind of RSI action in overbought territory for long periods of time, you pay for it. And the way you pay for it is by going down to the 30 level. We didn't quite make it, but came awfully close. And we are going to get below 30 and stay below 30 for a period of time. This is a reasonable place to bounce because this is the lowest RSI that we have had going all the way back to almost 2015. So notice also, though, that the long-term moving average had already turned down 4 weeks ago and now is accelerating down. These are very long-term 50-week and 200-week moving averages. And you can see that this penetration that occurred during the late summer and early fall and staying there was enough to turn the long term down in the previous 3-week period. And we have not seen that going all the way back into 2015, going into 2016. So at least we know this is a very substantial correction and could very well be the beginning of a major bear market. For me to conclude this is a bear market, after whatever bounce we can muster here, if anything, maybe we won't. Maybe we'll just have a day or 2 or 3 of upside and it turns back down. Then it should be very clear, as Tone says, when we take out the lows. At that point, I will go net short. But one of the things I wanted to talk about today is the implications at this point in time from the macroeconomic point of view. I have been saying, and Tone and I haven't been able to talk about this, but I know he's heard Leah and I talk about this before. To me, Bitcoin, gold, default, or growing out of the debt problem are the only 4 possible solutions. And I was hoping that we would be able to grow out of it because of the strength of the US economy and the US stock market. And that is what we are now challenging with the recent 4-week downturn in our market. It has not yet affected the overall economic situation. We did have consumer confidence drop fairly sharply, but from a very, very almost historically high level this morning. It was also slightly lower the month before. That's been the only time in the last 6 months where consumer confidence or corporate confidence has begun to wane. So what I think we are really talking about here is, are we eliminating growing out of the debt problem as one of the 4 possible scenarios? And my answer is yes. I'm afraid that that's being taken off the table with the recent price action in the US stock market. that brings us to the US economy. And in the US economy, we have the danger, because of what's going on with interest rates, of inverting the yield curve, which we have not yet done, except on a couple of very short-term time frames that to me do not count. The original inversion that people used to talk about had to do with the 30-year versus the 3-month T-bill. That then dropped down to the 20-year and the 3-month T-bill, which then dropped down to the 10-year and the 3-month T-bill, which then got watered down to the 10-year and the 2-year. And now what people were talking about earlier this year is the 5 and the 2. The 5 and the 2 are meaningless. The 10 and the 2 are more powerful in terms of being predictive of coming recessions. But until the 10 and the 30-day cross, most of that is insignificant. But I don't want to minimize the fact that how flat the yield curve has gotten. And if the stock market begins to drop, what we will see very quickly is long-term rates dropping below short-term rates. So that, to me, is a very important consideration about how far this bounce in the stock market that started yesterday can go. I want it to go up. I hope that it goes up. I think there's a reason to think that it could last for 2 or 3 months and take us back close to all-time highs. And now I'm going to be even more controversial than I tend to be, which is I do believe that the government, central banks, and policymakers, meaning foreign ministers, finance ministers, and the US Treasury Secretary, are in a position to directly affect the direction of the market. For the first time ever, the Secretary of the Treasury made public the terminology that we have all used for 20 years, the plunge protection team. Now, the fact that it was voiced publicly basically to me means for the first time, what everyone suspected now is being talked about by policymakers. And if you haven't been paying attention, for the last 10 years, it has been clear under Bernanke and under Yellen and now under Powell that they take credit for the movement up in the US stock market by keeping interest rates unreasonably low for an unreasonable amount of time. And
I know, don't you hate that? Don't you hate that, Tyler?
I hate it.
Tyler, can you go off screen share?
What's that?
We want to see your face. There we go. And yes, the answer was, do you hate it?
I do, but I've always hated it ever since 1987. I became convinced the Tuesday after the Monday massacre, where we lost 520 points or 22% in a day, was directly the result of government intervention by buying S&P futures at 10 o'clock in the morning on Tuesday morning. And by the way, that was with Alan Greenspan becoming the Federal Reserve chairman. And I believe that it had been used on a number of occasions between 1987 and 2000. And I believe it is still used today. It's not used frequently, but when I put myself in the position of someone responsible for the US economy, and for the U.S. position in the world and the world economy, I would use every tool at my disposal to protect that economy, those markets, and the world market. And the fact that it isn't talked about publicly, but we've seen, first of all, dropping interest rates to zero and then keeping them there longer than they needed to be, which caused two bubbles, one in mortgages and real estate and the other in the stock market, that we paid for in 06, 07, 08, and up until March of 09. And then with the recent 8-year zero rate policy and negative rate policies in central banks around the world, and then the admission and the victory lap taken by the Federal Reserve in saying that those steps that they took is what pulled us out of not only 00 through 03, but also 06 through 09, and now have caused the greatest bull market in U.S. history in terms of the length of time. Now, I think they've slipped up by saying it is our actions that have caused these things to happen. And to me, it's now out in the open.
Thank you, Ty. And on that tone, follow up?
Not really. I mean, unfortunately, with my current lifestyle, it's very hard for me to stay fully up to date on global, on like even US economics, right? And it's unfortunate. And this is what happens. It's maybe if I just stayed home and I mean, back when I was doing these videos, maybe not so many. When I started out doing these videos, I was doing like maybe what, 2 videos a week, sometimes 3 videos a week. And I wasn't traveling as much, and I was able to still keep up to date with what the hell is going on. Like I still, well, like half the time I still think that Janet Yellen is the head of the Fed and not Powell. Like this is what happens when your schedule becomes really, really rough. And I always said that they should have been raising rates years ago. Like this is really, really bad. And I think they should just continue raising the rates. Market will be fine. Like here's where the stock market gets in serious trouble. I'm gonna go back to screen share real quick here.
Great.
Well, and if I could add 2 cents while you're pulling up screen share. I personally think that more than ever before, international economics is tied. And absolutely, if anyone's been following emerging markets in Asian economies, I mean, it's complete contagion from China, which obviously is the 2nd largest economy in the world, to us, but catching up very fast. Japan is now 3rd, but everybody in Asia, and especially Australia, is getting a little dangerous, is following a lot of China. And especially like if you think about just the type of trade-offs you need to pick, right? I mean, in Singapore, STI, but also ASX, they need to, with politics, which Tyler was saying, a lot of these countries are now having to do a choice for their economics and financial situation based on politics right now. If you look at Singapore, really the ruling class, especially if you guys see Crazy Rich Asians, is absolutely Chinese wealth, and very much coming from Beijing originally. So it's insane. And yes, Euro stocks are, super bloody today. Everything's super bloody. And as you mentioned, Tyler, more than ever, it seems that the stock markets are following news from here in Washington, D.C. And I guess to tie it all back to QE, QE1, QE2, and all those fun QEs, it was never meant to be that the Fed was allowed to have, in my opinion, this amount of power, like changing the federal funds rates overnight. Right. But now when Powell says something, before when Yellen says something, but especially now, and even when Trump says something about Powell, you have these massive movements that just, for sure, when you were talking about Greenspan, Bernanke, and it's just been building and building and building. And now today, the markets are following what's going on with interest rates. But yeah, I guess to finish it off regarding what I was saying about emerging markets in Asia, and regarding interest rates, what you were saying, Like even I think I was reading yesterday, Indonesia raised it 6 times this year to 6%. I think they're at, and it's been historical. The BOJ has had, negative interest rate. I mean, it seems as if central banks don't really know how to deal with this global situation. So I'll stop my rant. Tone.
All right, let me, I just want to clean up the chart real quick. I want to drop the...
Tyler, do you disagree?
Yeah, I'm good.
No, the globalization of the economy, it's always been global, but now because of the internet and because of borders dropping worldwide in terms of trade and information flow, everything is tied together. And I've been worried that the US cannot continue to be the only strong economy in the world, growing more than 2 or 2.5%. And what I'm really worried about is if this is really the beginning of a bear market in the US, then there's simply no way to grow out of this problem. And so I want to see Tone's analysis of this long-term S&P, because that bottom of that channel is very interesting.
Let's see it, Tone.
Yeah, so here is the 10-year look at the S&P 500, maybe a 12-year look at the S&P 500. Like, what is scary about this chart? I'm sorry, guys. There is nothing here that is scary at all. We have bounced off the bottom of the purple channel twice before. We have touched it again. Now, here's what's different this time. The only thing that's different this time is that we overshot the channel. We overshot the channel twice. There was this massive divergence, probably the biggest divergence I've seen on the S&P 500 in probably my trading lifetime, obviously, because this is pretty much my trading lifetime. I started trading in, when did I start trading? So I started trading around mid-2000, I started trading in like late 2004, early 2005. By 2006, I realized there was a housing bubble. So between mid-2006 and mid-2007, I blew up my portfolio continuously shorting real estate. When I ran out of money, I went and got a job at Bear Stearns, which went down 6 months later because of real estate. Like that, this is the irony of the situation, right? But anyway, so we're looking at this chart. Look, here's where, because we overshot the channel, and this is no different than Bitcoin. Bitcoin also overshot its channel, and Bitcoin is now below the channel. I'm seeing some reasonable strength that might force us back up, but I do think we're going to run into resistance. I think 2019 is going to be a tough year, and most likely only because we overshot the channel, it's very likely we're going to undershoot the channel. If we undershoot the channel, going back down to this 1.618 Fibonacci line, basically the 2015 was a dead year for the market. It made 0%. It topped early in the year in 2015 by, wait a minute. Sorry, 2016 was a dead year because in January of 2016, we crashed hard. But in any case, let's take these 2 years, for example. So from early 2015, all the way until the summer of 2016. So for a year and a half, the stock market had a giant dip and then it went back up. This is a huge support line of prior swing highs. Now, this is the line I expect to hold. I expect if we break below the channel, and we may not, we may come off of this here and go back to new all-time highs. The slightly more likely scenario is that we do fall and bounce off of this line around 2136. If we don't, if we break this line, the next level of support is down at 1573, which is the 2008 all-time high. And you know what? If we go back to the 2008 all-time high, that's not necessarily a bad thing. It's not great. I would rather have us bounce off of 2130 and go to new all-time highs. But even if we do go all the way back to the prior 2008 all-time highs, it's technically, by definition, a healthy uptrend of historical 100-year trend. Only if we fall below this number, only if we fall below 1576, am I actually going to get nervous that America is going to get dethroned as a superpower. And at the moment, I don't know who's the next country is going to be, right? So as long as we stay above 1576 on the US stock markets, America isn't going anywhere as the global superpower. Tyler, you disagree with anything I said?
Not at all. I agree with everything you said. The one problem with the US going down as low as the highs back in 2006 is just imagine what the rest of the world is going to be doing during that period. There can be no strength anywhere else in the world. China's debt situation is much worse than the US situation. And there is reason to believe that they are much closer to financial Armageddon than we are. So even if we are okay, meaning that we're still the strongest country in the world, what it will do to the rest of the world in terms of trade, imports, exports, currencies, debt situation. Remember what we're talking about here, folks, is we're talking about super deflation, not super inflation. Because as soon as markets begin to drop, money moves into bonds, which means interest rates go down. And when interest rates and markets go down, you have deflation of commodities and you have deflation of economic activity. And that's what we're fighting with all of this credit and debt problem around the world, that you need to satisfy that debt. And the easiest way to satisfy debt is for interest rates to drop, which drops the interest rates on that debt. And you either do it by choice or the markets force it on you. So I agree with everything that Tone said, but I don't want to be the strongest country in a worldwide depression. And I would rather be somewhere in the middle in a very strong economic world, but that's not what we're talking about.
Just adding to that, absolutely. And for emerging markets, they inflate away their debt, right? And that's so everybody's asking about hyperinflation. You're talking about deflation. That was everybody should know that deflation is way worse than inflation. You can look at Japan as an example for that. But for emerging markets who are going to get royally screwed in this situation, yes, for the most part, you'll inflate away the debt, which will make their situations much, much worse. And this is a beautiful chart, Tone, so I can't wait for you to explain it. Last thing I'm going to say about China is absolutely, I mean, there's only so long that they can hold off the absolute implosion that will happen in China. I mean, they've done pretty much everything under the sun by continuing to peg, by refusing to go to the WTO, just breaking all the rules. But if you look at NPLs, non-performing loans, as well as just when Tyler's talking about debt, the regional debt, also through shadow banking and just this really credit implosion as well. For it's been a nightmare, and it's starting to show up in the markets for sure. If anyone's following the Shanghai Composite, especially, but it'll continue to show up. And I guess last point on that is just you can especially see it with their latest plans. I mean, the Chinese are brilliant at putting out 5-year plans, 10-year plans, 15, everything. But right now, their latest plans simply don't make much sense and really aren't able to hold this worldwide really recession coming at bay, and you can see it in the markets in not just China, but in Asia. And rant done. Tone, beautiful chart.
Yeah, thank you. So this is a chart I put together a few years ago, back when I had time to make these awesome charts. And I really love making these types of charts, like these historical looks, look for historical patterns, try to, defy the general convention. This was part of the presentation that I gave. It was the only time I ever gave this presentation. There is a video of it. It came out like a year later. It was at the Anarchist Conference in Acapulco, where I basically tried to explain to people that why do you always want the stock market to crash? And you've been wrong every day, pretty much, almost every day, right? Like in 1987, there was a day. In 2008, there was a year. There was the tech bubble in 2000. But overall, this is the world of the stock market since the creation of the Federal Reserve. And again, look at this uptrend. I spoke at this conference back in like 2016 or something like that. I don't remember when I did this. And I think that was the same, I think it was like the day before I debated Roger Ver over Bitcoin Unlimited. And my target for the Dow Jones has always been $75,000 coming in the year, what's that year there? Around 2034, around 2034, 2033. I'm looking for the Dow Jones to go up to $75,000. And if you look historically, this is like a bigger uptrend. Look at this green dotted line that I extrapolated from the last low in 2009. It's the same green line that I extrapolated back from 1974 that leads us right into the dot-com bubble. And the top in 1987 perfectly hits it right here. And the price action was completely below that line as we went all the way up there. And this time around, the price action is completely above this line. Same thing. Here's the same line being extrapolated forward back from the low in 1942. And the action then was half above and half below. And here's a similar line from the creation of the Fed, and we grossly overshot that line during the raging 20s. Like, there's nothing long-term that is telling us that the U.S. is done being a superpower. There's just nothing there. It's just another correction. I don't believe this is going to be as bad as 2008. I personally don't. They are going to inflate away. I mean, they got plenty of room to print. I think the only thing that the Federal Reserve and the Treasury and Congress, I think the biggest takeaway from 2008 is this, and see if Tyler agrees with me. I think they have realized no matter how many trillions of dollars they print, they can't cause inflation.
I completely agree with that. And that's why I say the problem is deflation, and they know it. And the reason for that is where the world still has negative interest rates, not as much as they did before, but very few rates around the world are more than 1%. It's only in the United States and a couple of other places where we've gotten up close to 3.37% at one point. Now we're back down to 2.74. But the reason that's important is central banks need to be able to cut rates in order to print money or stimulate the economy. And in 2006, we got up to 6.5% on the 10-year rate. Today, we've only got up to 3%, which means they've got half the firepower that they did back in 2006. But if you look at Japan, they're at 1/4% interest rates. And you look throughout Europe, you're between 0.5% and 1.5%, some getting up as high as 2%. That means the central banks only have the tools to cut from 1.5% back down to 0, and then they're out of tools. And that's why this is a deflationary problem, not an inflationary one, unless your Zimbabwe or Italy or Argentina or Venezuela, a localized economy that is got such debt problems that they're not in a position to control inflation and their currencies fall because of that. That's not what we're talking about in terms of the US, but it is what we're talking about in terms of world debt. And since the US has been the only engine of growth for the last 10 years relative to all the others, the world cannot have the US sputter. And one of the things we're talking about today is the US sputtering, which brings us full circle to what Leah was just saying and what we have been saying all this year, that I am hoping that a new tool has been added to the toolbox of central banks and major banks around the world, which is Bitcoin. And unfortunately, the Bitcoin experiment got sidetracked because of the creation of 3,000 alternative projects that completely confused the regulators and the public and the institutions about what Bitcoin stands for and how it can be a solution to this world debt credit problem. Unfortunately, it resulted in a hyperwave. Unfortunately, that hyperwave overshot and now is on the downswing to wherever it's going to go. And that leaves only a gold standard, default on the debt, or growing out of the debt as the three viable solutions. If we can somehow keep our stock market and our economy from dropping to the extent that it is going to cause a worldwide recession, then maybe we can grow our way out of this 2 years from now or 3 years from now. But my fear is that the next step by central bankers and large world financial institutions will be to attempt to reinstate a gold standard while Bitcoin is struggling. And if that's the case, we will see it show up in the price of gold and silver. And I still have not seen the evidence that that is what is happening. And that's why this entire discussion is so important, because we are attempting to understand how does the world, for the first time in its history, work itself out of a debt credit problem that has come about because we closed the gold standard down in 1971 following Bretton Woods. And we've been running deficits and debts worldwide that have been exacerbated by central banks being put in a position to have to allow tremendous liquidity through the printing of money by buying back bonds in the United States or by directly intervening in markets in China and in Japan and elsewhere around the world. So our discussion about is this a bear market or not, how high is it going to bounce right now, how low might it get, is really irrelevant to the much bigger question of what does this all mean in terms of solving the problem of debt and credit.
Thanks, Ty. Tone, more beautiful charts.
Yeah, I'm trying to, 1 second here, DGS. I'm trying to get the ratio between the 2 and the 10 year. So DGS 10 divided by DGS 2.
So for everybody,
but it's not working. Or is it? It's working. Boom, there it is. So here's the ratio between the two. And You know, we're coming down towards inversion, but we haven't had it yet. Not on a closing day basis. And yeah, this is interesting. It's coming down, not there yet. Like, I agree with Tyler. The only interest rates that matter are the 2 and the 10. I don't really like beyond that. Like, the 6-month matters a little bit, and the 30-year matters for those that want to buy a house. But that's it. The 5-year kind of matters a tiny bit, but it's always the 2 and the 10. And look, back in 2015. Wow, look, back in 2014, this ratio was huge. It was 9. 9.
Yep.
Wow.
And that's because the short-term rates were artificially held down and the long-term rates were determined by the strength of the economy, which was getting stronger and stronger. So you could get the long-term rates rising and the short-term rates are artificially low. And we have to go back to 1979, 1980, and Paul Volcker to understand how simple it is if the Fed has tools in order to break the back of inflation by simply raising interest rates to a level at which economies are forced to slow down because they can't borrow at those high rates. And he did it, and it worked, and it was the top of the largest hyperwave in history, which was the credit bubble in terms of interest rates that started after or during World War II in 1942 and ran all the way until 1979. And we've been dropping ever since. Now we are no longer dropping because once you've hit zero, you can't go any lower on interest rates. And that's why this debate about interest rates is so important.
Well, again, I like the sequential here. We had a sequential and aggressive bottom out in September of last year. We had a TD9 come in December of this year. This is the daily chart. I can go to the weekly chart. We can take a look at it on a little more long-term basis. And I would love to, I mean, we don't have the time, but I would love to overlay the stock market onto this and see what the spread between the 2 and the 10-year can give us as far as correlations on the stock market. I mean, we know that the stock market has been on a giant 10-year tear. Like, I'm trying to see when did the spread start going up because all I see it is going down. Here we go.
Go back to 06. And that's what happens in recessions is that spread gets down and actually goes negative, and you get an inverted yield curve. And that's why it's so powerful in calling not only stock market drops, but also recessions.
Right. So again, like you and I had a long discussion about inverted yield curve, and we don't have an inverted yield curve today. But then again, it's very different this time because rates are so low. So I don't know what an inverted yield curve means in the current rate environment, and no one else does either because we've never had a rate environment of this low magnitude before. So we have absolutely no clue what it means, but you can see right here, and I'm zooming in for a reason. I actually don't really need the moving averages. Let me turn those off. So, and here's what we mean about an inverted yield curve. I want the one line. So let me do something real quick here. So if I go here, I go background. I want to drop this because they're in the way, and I want to drop that because they're in the way, and now I want to grab just a line, and we'll make this line. I usually make these blue, but we'll make it like purple, and I'm just gonna draw a random line, and then what I'm gonna do is I'm gonna give it the Did I just draw a line at exactly one randomly? Wow, right, that's impressive. I was going to go there and I was going to set it to 1. And I'm like, holy shit. That was like a randomly drawn line. And this is what you're looking for, right? Remember, this is a weekly scale. So we crossed into an inverted yield curve in December of 2005. We slightly broke out of it in January. Then we spent between middle of January all the way into March with an inverted yield curve. We then got out of it again, went back into the inverted yield curve between June 2006 and stayed in the inverted yield curve all the way until March of 2007. And none of this, we still had a bull market. Like the market didn't top till like when? Like I think February. I think the first sign that there were problems was, again, my memory is fairly good when it comes to markets. It was February 27th, 2007. Go back. This is your homework, people. February 27th, 2007. February 27, 2007. Go look at what happened that day. That was the first sign that we have problems. But the market continued going higher. Like, I don't even need to overlay the stock market on this. I know exactly what it did. I was at Bear Stearns. Now there is a little bit of a there's a reason why I remember that day so quickly, because I had just started working at Bear Stearns. But any case, so all of this time spent below this line was the inverted yield curve in a bull market. That's the problem. And in today's world, we're actually not. We're getting close to it, but we're not there. And let me see if I can get to, wow. So here's that same line. Just want to extend it all the way down. And I want to go into today. And here we are, right? Like, we're not there yet, guys. We are not at, we're not there. We're not there.
And the important point is that Tone is pointing out now that an inverted yield curve is a precursor to a recession, but that recession does not happen until 9 months to 18 months after the yield curve is inverted. Now, you overlay on that the stock market. The stock market tends, when it goes into a bear market, to be a precursor to a recession. So first comes the inverted yield.
Oh, wait, hey, Tyler, what do you want me to overlay, S&P or Dow?
Yeah, S&P would be good. That's what everyone tends to use. The Dow, just with its 30 stocks, sometimes doesn't pick up certain things. So first you get the inverted yield curve, then you get a stock market bear market, and then you get the recession.
Just a note though, and you can tell me if I'm wrong, but and historically, absolutely, there's such a strong correlation that we're looking at right now between obviously the yield curve inversions and recessions, but correlation isn't always causation, right? So just that there's all these things that we're talking about, good reasons, and especially on our shows, to that the relationship between the slope of the yield curve and these business cycles, are just changing, and there's just so many factors. But just one thing for everybody that's listening, just so everybody knows what an inverted yield curve means, is just that the interest rates on long-term bonds is lower than the interest rates on short-term bonds. And this is seen as a bad sign for the economy, because long-term rates might go down, inverting the yield curve if markets expect that the economy is going to deteriorate and that the Fed will cut these short-term rates in the future. So just so that everybody knows these terms. All right, off to the races, Don.
Yeah, so here's the overlay of the market. And again, yeah, we took a hit, but like we just went unreasonably too high. It's no different than Bitcoin. And like I said earlier, as long as we hold the 2015 high, we're okay. And if we fall below the 2015 high, as long as we hold the 2007 high, US will remain the superpower, right? Then we got trouble. But we also could have already bottomed for the year, like for next year too. Like we could have bottomed for the decade at this point, right? We don't know yet. It's always too early to tell. like I said, what I did know was the moment, like 2 weeks ago, I knew we were going down. 2 weeks ago, once we broke the prior swing lows, I knew we were going to go down to the bottom of the purple channel. Did I expect us to go down to the purple channel in 3 days? Absolutely not. But this is why there are price targets and time targets, right? If you can hit them both, you're going to be a billionaire. But nobody can hit them both. It's very, very difficult. So this is why option trading is so hard, because you got to hit them both.
That's exactly right. The thing that is exactly right is putting all of these stories together we've been telling today. Right now, right here, is a very important point in terms of macroeconomics, because things are happening at all levels, not only growth levels, but interest rate levels, currency levels, precious metals levels, Bitcoin levels. All of them are coming together at this point in time. And it's very unusual. In fact, I would say it's unique. And the reason this is unique, and nobody has the answers, so you need tools on a daily basis to tell where you are relative to all of these things. You cannot get that from fundamental analysis. You've got to get it by looking at how everybody is actually placing their money. And everybody means central banks, major banks, regional banks, corporations, institutions, pension funds, and individuals. All of them do their own research and decide to buy or sell. And that shows up in price. And what I'm saying is we are now at a point, because of the globalization of everything, communications, information, movement of people and goods, movement of money, and money as a store of wealth or a store of value is being reinterpreted over the last 10 years because of Bitcoin and crypto. And because of all of that, making a decision that this is going to happen or that is going to happen at some point in the future, in my mind, is ignorant. You must take it step by step, piece by piece, and continually analyze it and put it all together in order to protect yourself.
I just want to close out. I think we're getting ready to end the podcast, right, Leah? I'm just going to close out with something to get the people interested in our next show. Tyler, I disagree with you on the gold standard. I don't think it's coming back. I don't think there is a single economist that's on the payroll of any government that is interested in bringing back the gold standard. I don't see that happening. I don't know what they're going to do, but it's not going to be a gold standard.
Well, I hope you're right, because that will not be a solution to the problem. It will simply push it off, but it could push it off for 20 years or a generation if they can come up with a scheme in which it isn't tied to a currency like Bretton Woods tied it to the US dollar. But if it's tied to a basket of currencies and to gold, in some kind of a formula that everybody accepts, getting everybody to accept it, good luck. But I don't see any other solution other than default on that debt, because growing out of it, I just don't think is going to happen.
All right.
But that will be a lot of fun, and we'll do a whole show just on that.
Thanks, Ty. All right, to close this out and bring it back to Bitcoin, and yes, Tone, we have our next show in 30. So absolutely everybody should read the Bitcoin Standard by Seyfedin Ammous. And he did say there's a little line, and also he mentioned it on the Mises Institute, where the one thing that could destroy Bitcoin would be if we went back on the gold standard. So I guess if there's one thing that we can agree here, although Tone's shaking his head, is that it would be good or prudent if we didn't go back on the gold standard. So go Bitcoin. Okay, I'm closing it out. Guys, thank you so much. Tyler, partner, I've missed it. Thanks.
Thank you very much. And again, everybody, it's all happening. It's all happening in just about a month, and it's going to be in Las Vegas. Those of you who have not yet signed up for the Hyperwave workshop, please do. Those of you who have not signed up for Unconfiscatable, you better hurry, because I'll bet within the next week or so it's going to be completely sold out.
Awesome. Tone, thank you for joining us.
No, thank you. It was great. Thanks, Tyler, for everything. And yeah, I will see you in Tennessee a few weeks before Unconfiscatable. See you guys there. Check out unconfiscatable.com. You can still register for my workshop, Tyler's workshop, the conference itself. The poker tournament still has some seats, and the carnivory dinner has a couple of seats left. That's pretty much it for me. We're going to try and do one more stream. Try to keep it short. I think Jimmy's around. We're going to look for a couple of stories for you, and we'll cover those in about 30 minutes. So head on over to Tone Vays. I guess it's a podcast day. I'm still may or may not do a law show later today. Depends how many lawyers are free. But it's starting to look a little more unlikely. So we will definitely do a news show. I'll try and cover a little bit of Bitcoin. See you guys there in 30 minutes.
Oh boy, our brain's going to be fried. Everybody, thank you so much for watching. Take care.
Great. Bye-bye.